Here's what we're going to do. We have an awesome guest panel with quite a bit of M&A experience. We're going to spend about 40 minutes on Q&A. We kind of have a number of questions across the M&A lifecycle. We're actually going to go fairly linearly from strategy through integration. And then we're going to have about 20 minutes for whatever the hell's on your mind, okay? Let me start with introductions, and then I'll just send it down the line. Jeff Rudnicki, senior partner at McKinsey in Boston. I helped lead M&A for McKinsey. I've done M&A my entire career. Before McKinsey, I was in antitrust, and then at McKinsey, I've been in M&A. I also lead our Boston office. I live in Winchester. I have 3 kids, and on the weekend, you will find me at a hockey rink.
Thanks, Jeff. Lou Arcudi says former Chief Financial Officer of Amlet. So I've been in the life science biotech industry for over 25 years, CFO, CEO, and board member. And my recent M&A transaction is we just sold Amlet to AstraZeneca, just closed about a month and a half ago for just over $1.2 billion. And fun fact, that was the largest acquisition in a French company's history. And live on the Cape, Dennis, Massachusetts, and love to travel now that I am retired.
All right. Mark Nassif, COO and CFO at Lookout. For the last 25 years, I spent time in the technology industry, specifically in networking and cybersecurity. In the last 4 years, I've done 3 different transactions, 1 spinning off a business unit, 2 buying 2 different companies. And over the course of the 25 years, I've probably done over a dozen transactions. Love to be outdoors. Prefer to be on the water or up in the mountains, snowmobiling or skiing. So, thank you.
All right. My name is Shu. The same pronunciation as the shoe everyone is wearing. So just for easy memory. Most of my career is with the private equity-owned companies. So typically, I join a company following their investment cycle, and including, all the value creation, and M&A play a big role in this value creation journey. So over the past decade, I have done deals from $20 million startup acquisition all the way up to $6 billion sale transaction. So I'm very happy to be here to share some insights and also the lesson learned through the many, many M&A I have done. So 2 children, local Newton, so it's probably I'm very close to this place, 10 minutes from here. So very happy to be here.
Hey, Dan O'Shaughnessy, currently the CFO at a 3D printing company called Formlabs out of Somerville. Most recently did the smallest M&A transaction of my career at about $600,000. I think I was on the largest French disposition ever. When GE bought a questionable asset, but so have done deals anywhere from 600,000 to 26 billion, strategic or PE, so really across the board, buy side, sell side, and happy to chat with you guys today. I also have a hockey family. For a 4-year-old who spends his entire weekend at the rink and a couple days during the week, 1 more on the way, and we're down in Hingham in the South Shore.
Terrific. Maybe start with an engagement audience question. Raise your hand if you have significant M&A experience. Raise your hand if you have almost no experience. Okay. For those with experience, hardest part, so it's 4-parter. Raise your hand on which one of these is the hardest part. Getting the organization aligned on the need for M&A and the plan, that's the first one. Getting the diligence right. Translating the diligence into an integration plan, or actually executing the integration. So show of hands, getting the organization aligned on the need for M&A and the plan. Who thinks that's the hardest part? 1, 2, okay, few. Getting the diligence right. Raise show of hands. Half a hand, I think. Okay, I know where this is going, I told you. Translating the diligence into an integration plan. A couple hands, 6, 7, 8. Executing the integration. All right, 90%, okay. All right, so we'll spend some time there. A couple folks have asked us in the hallway, what does this election mean? What do these lowering interest rates mean for M&A? Ask the audience. Less M&A, about the same, more, or a potential boom for M&A? So less M&A. Who thinks that in the next year, 2025, there will be less M&A? All right, about the same? We got one. A little bit more? More? Okay, and then a lot more. Okay, so about almost half more, and about maybe 40% a lot more. Okay, interesting. Yeah, I saw your hands up, so.
Yes.
Okay,
I
all right.
personally think there will be a lot more.
A lot more, okay. A great place to start, if there's gonna be more, getting the right strategy. So maybe we'll start with your M&A plan and building kind of a proactive business development muscle or function. I'm gonna start with those two closest to me. You guys have some experience on this. So when you think about building out an M&A plan, building out a proactive target list, getting your board, your investors, your executive team on board, how did you do it? What are some lessons learned, failures, et cetera? Start with you, Lou.
Me? Okay, great. Well, can you guys hear me? Yeah. Fantastic. So I think, in the biotech space, again, not sure where everybody else is in their industries, but I think biotech space, it's quite easy when you think about getting your stakeholders aligned, right? Because most of the people already are specialists in those areas. So when you're thinking of building out your M&A strategy, if you're an oncology company, most of the team is oncologists or people or your investors. So that part is easy. What I would like to focus on is really the plan. And when you think about a biotech company, for those people, just a level set, if you think about it, I think the stats are 1 out of every 5,000 products that actually enter the clinic will actually be a commercial product. It takes anywhere from 10 to 15 years to actually get a product from starting clinic all the way to commercialization. It's they say $1.3 to $2 billion to get a drug approved. Just to get it approved, that doesn't mean break even. So if you think about it in the space and being a CFO, it takes a long time. There's like a 10% probability of success. It costs a lot of money, and not everybody is going to be successful. So what you do when it comes to an M&A strategy in the biotech space is really focus on your news flow, because that's where the value is really for your investors. You need inflection points. And if you think about a trial taking 3 years and $400 million to do, as Shu knows, it basically, there's a lot of white space, right? So when you're looking at your news flow and your inflection points, it might be 2 years before you actually can make any announcement, because it's all blinded, you have no idea, and it may not actually turn out good. So what you have to do is you always have to be pumping the pipeline. You always have to be bringing new programs in, and you do that either organically if you have a discovery engine, and a discovery engine can cost $500 to $750 million a year just to run, or you do it by actually acquiring companies or assets. So that's really, I think, the strategy. I don't want to focus too much. We don't have a lot of time. We could spend an entire hour on this, but really the strategy for a plan and the CFO is really important, because you have to actually be looking from an investor relations standpoint. When do I want to have an inflection point? I always have to have news. Every couple of quarters you have to have something, or your value or your company's going to go down. So you're always looking at that news flow, and then you try to backfill it with M&A transactions, and then you work with your M&A department. And it really, final point I'll make, it really has to be a synergistic story, because if I'm a neuroscience company dealing in ALS or Alzheimer's, I can't then all of a sudden acquire an obesity company, right? Because that makes no sense. So that's why the plan is important, and everybody on the team usually comes from the same background, so they really, there's not a lot of infighting there or disagreement. So I think I'll stop at that.
Yeah, I think similarly, the synergistic part is important. We look at, so one of the things we've always done is, every year we spend a couple of days off-site just talking about strategy, looking at, what strategic partners we may want to do business with, what strategic technology we may want to take in. And we spend time just focusing on that strategy. And as part of that strategy, you start talking about the M&A and what technology you might want to just first maybe OEM to start with, versus then go and acquire. And that's really, and then a lot of times we'll bring the board in during the second day to read out to them, kind of, and get their insights into what they're looking for and what they think, because they're, most of our board is VCs, so they've got a lot of exposure to different companies. And so it's usually a 2-day session where we're really looking at, what are the adjacencies, what are some of the synergies from a go-to-market perspective, from a technology perspective. And it could be anything from, buying another product that's going to give you, double your revenue, to just some small technology that you want to tuck in. Including, at times we've done just acquihires, where, we need a few more engineers in a certain technology. There's a company that has it but isn't doing so well, so we'll pick it up. But we spend a lot of time, at least once a year, looking at that. And a lot of times it starts with partnerships. We'll start with a partnership with an entity before we then either go buy it, or, the opposite, before they want to look at maybe buying and acquiring our technology.
Maybe just, can you share more, Mark, can you share more on an example? Because that's a increasingly common idea, this idea of we might not have the capital, we might not even be sure this is the right asset. We want to get to know this company. Can you share maybe some lessons or an example?
Sure, and a lot of it is because we're a smaller company. We've done, we have partnerships with, today we're in the mobile security, so we protect mobile endpoints. There's other things like mobile device management, so there's a company like, it used to be VMware. And so we formed a strategic partnership with them where they wanted to OEM our technology. And, as we think about kind of next steps, right, in who could acquire us, right, versus us acquire somebody, that's a company that is, strategically, it could make sense because the technologies fit well together. And we've done that, over the years. Back when I was at Juniper, we looked at technology, where again we would OEM to start with, different technology, see how well it went for 12 months, and then bring it into the fold.
Terrific. That's terrific. Maybe my reflection, talking to companies about M&A every week. Sorry. What gets in the way of great M&A? First, many companies do not actually have a clear strategy. They actually don't have a clear strategy. What are the markets they are in, want to be in? What are the customers they want to serve, and how do they create value versus somebody else? That's like the first thing to get going. I think the second thing that we see a lot is where in that strategy is M&A needed and where is it not? And that kind of deliberate connection, it's probably not needed everywhere, but you better be pretty specific as to where you see M&A playing a role. And then if you have that, whose job is it? Whose job is it to kind of activate, cultivate targets, do the diligence, help lead the integration? And if it's only the M&A leader's job, you're doing it wrong. The CFO should play an active role, the CEO, business leaders for which we think M&A is going to be a big part of their growth. Those are sort of maybe three lessons from companies that are just getting going. Sorry, any comment? Yeah, please.
Yeah, I was going to say from a technology perspective, it's interesting because as a CFO, I'm actually pro M&A. So, but as from an engineering perspective, it's like I can build it, right?
Yeah, of course.
I think we know that, right? Every engineer can build something better, and so it's those discussions that we have at this strategic meeting is at times they can get we can get a little heated because I want to buy it versus build it, and they want to build everything, and we go back and forth.
Of course.
Yeah.
And, Dan?
Yeah, and writing it down is super helpful, right? You often have these conversations when your board member sees a deal that came across their desk or that they didn't hear about, you might have heard about it, you made an active decision not to engage there. You can have your CEO could get really excited about something and then say, we need to be looking at this, how much time do you spend on it? To your point, it could be an acquihire. I met somebody really interesting. It's a small company. I'd be willing to pay X amount of dollars for this talent. It could be financial. We think it's accretive. It could be strategic. We think financially it doesn't make sense, but strategically it does. And it's amazing what happens when you write that down And anytime a deal comes across your desk, anytime you meet with somebody, anytime a board member calls, anytime my CEO gets excited, we just pull out that piece of paper and says, which of these boxes does it check? And then where are we going stupid on ourselves and had a great dinner with a great CEO, and we're trying to figure out a way to make that business fit with our business, and oftentimes you do a lot of work and it doesn't make any sense, and it never did from the beginning. So write it down.
And I want to echo that piece. So in the PE-backed environment, so typically we have a playbook for value creation. So over a certain period, everyone know, right? PE is not going to hold a company forever. So there is a certain window, sometimes 5 years, sometimes 3 years, it depending on how the company can perform and depending on the market. So typically, we build a playbook for the value creation over the next few years. And then we look at, okay, which one we want to build in-house and which one we do the M&A. And then with all the M&A opportunities, which one fit in the value creation opportunity that we have on the book. So write it down is very important. So we know why we're doing it and why we're doing certain deal and what is the deal thesis behind everything that we try to do.
I think a good segue maybe to diligence. By the way, this concept of we can do it ourselves, we've done it ourselves, resonates quite a bit. I saw folks nodding their head too. A fairly famous consumer company on the West Coast, which has spurned doing M&A. They have not done M&A, and I talked to them. They're starting to do M&A. And their rationale was not, we can't do it ourselves. We can do it ourselves. It just takes too long. The market is moving too fast. We're in a highly evolving industry. The second thing you hear a lot increasingly is we need M&A as a catalyst. We're trying to do something. M&A will catalyze and speed up kind of what we're trying to do. Let's go to diligence. So all of you who raised your hand have been involved in diligence. You all have some diligence experience. Maybe, Shu, I'm going to ask you a question. So there's the financial diligence, kind of getting the model, getting the numbers right. There's the strategic diligence. Does this fit, like you guys were just talking about? Does this fit where we're trying to take the company? Where is it a stretch? Where is it maybe totally on brand? The softer side of diligence, talent, culture, operating model. How have you approached that? What are some lessons learned that the audience could benefit from?
Yeah, so I see most of the people have experience about M&A, so I'm not going to play, we need to talk about 10 things in a due diligence, but I want to focus on only the 3 things, which is I feel like personally, I think it's very important. The number one is let's always remember the deal thesis, like why we're doing this deal. And look at all the questions that we have. We probably have hundreds of questions from different stakeholders, but how many questions related to the deal thesis? So for example, if the deal thesis is a market expansion, do we have enough questions related to the revenue, the customer trends, who owns the relationship with the customer, right? What is the pricing strategy? Do we have enough questions related to the market expansion? If the deal thesis is cost synergy, do we have enough questions on how the cost structure, how we're going to add value because of the synergy, and who is going to execute that? Do we have enough capacity within the company? Who is the leadership team who can execute the journey? So these are the things I always want the team to think about. Step back and look at 100 questions we're sending to the, the investment banker, right? Which question is relevant to the deal thesis, and which question is good to have, but it's really not that important. So that's number one. And number 2 things I want to mention is a lot of people, during this modeling, we have a lot of pro forma, we have a lot of one-time, we have a lot of, strategic system implementation. But at the end of the day, I want to remind people, what is the cash flow, right? How much cash, because of this deal, how much money that I invest in the deal, and over the next few years, how much cash I can get from this business. So this is something that I learned, through some of my experience that we forget about it. When we look at the pro forma, the EBITDA looks fantastic, right? With so many things we can do. But at the end of the day, what is really the cash? On my banking account, is it accumulating more money, or am I actually losing the money? So this is a very, very important step to look at, okay, what is really my cash EBITDA? How much cash I can bring in? How much cash return that I can bring back to the investors? So that's number 2. Number 3, I think, which is the culture piece. I found it's, through the conversation, it's very important to understand who you're going to work with, because the M&A is not the end of the story. It's the beginning of the marathon, right? You're going to partner with the business to execute. You're going to partner with the right people. Do we have the same mindset to execute the journey? Are we aligned on the integration, like how we're going to see the value for these assets? So I think it's very important. And through the conversation, we can see, okay, which one we're in line. which one we're not in line, but has the potential we can partner together, and how we get aligned as a whole team. So these are the three things that I found very, very important through my experience.
Yeah, I'd say the people and culture piece is oftentimes the most important, right? We're all great at making a business look great on a spreadsheet, terrible on a spreadsheet. Oftentimes, even right when you're principal to principal, you're largely aligned on what's going to happen, who's going to have their job at the end of the day, who's not going to have their job at the end of the day. What I've found is that when you go that next level down, when you have sort of, you go from 5 people involved in the deal conversation to 15 people involved in the deal conversation, that's where you get the most information. And if you have people that are very supportive, right, your plan is going to be very different than if you have people that are actively subverting this transaction. I have one example where we were selling a few assets from a public company. It was getting leaked, like very specific details were getting leaked, and it was to the point where we had to start sending out emails that were slightly different to everyone in order to catch who was leaking. But it was very, and again, this is, that was the first time that I saw it. It's certainly not the last time that I saw it. And so it really changed the mindset of the buyer, right, as to, like, can I run this business without all of these people, right? Because if they're actively trying to kill this deal or take more for themselves or send the wrong signal to the broader organization, you need to consider it very, very differently. And even if it makes all the sense on paper, which it did, you really had to push, to get these people who are subverting the deal out, because oftentimes it's a personal grudge. But you need to think about the deal differently, where if everything goes sideways, can I still transact this? And like oftentimes the answer is always yes. Is can you transact it in an effective way, or do you need to add an extra $5 million on your assumption, or $10 million on your assumption? And do you need to plan to have effectively 0 people of the target co working for you sort of day 2?
Yeah, I mean, I agree on that. I mean, culture is important, very important, especially if you're thinking, I'm just going to talk about out-licensing in this case, it's really important. I think you were touching on that, especially in our space. You're really looking to make sure that the acquiring company of who's taken that asset really has the same core values. I mean, we talked about that earlier today, right? Making sure that their core values is not the same as ours, but actually has the patient and the caregiver in mind. And we walked away from deals where we could have gotten a lot of money, whereas we just didn't feel the acquiring company actually had the same value for customers as we did. And the last thing you want to do is give an asset up that your discovery team worked years on to somebody that's just basically not going to take it to the same level or the same care that you are looking at, that we were looking at. So I think, that is definitely one of those soft things that we would look at when we were talking about out-licensing assets.
Maybe just last one on this, and then we'll get to maybe more integration topics. If you're sitting across the side on a transaction, it's highly likely that you have similar mission, vision, values. Mm-hmm. There are cases that's not true. You find it out. It's just a talking point. It's not the reality. For us, when we think about culture, we think about how work gets done. It's not the same mission, but it's not the words on the wall. It's how does work get done? It's things like, is there clear hierarchy? Is this company data-driven in their decision-making? Are they using their intuition? Does there seem to be role clarity, accountability? Those are the sort of things I would think about, because if those are different, the mission and vision values might be the same. If one company's very top-down, CEO says this, everybody runs. Another company is very different. That's where you're going to feel this clash. And that's where you have to really, question whether this is the right deal. And if it still is, I think a very thoughtful kind of measurement of the cultures, and then integration plan that's specific about cultural integration. Those would be my recommendations. Let's talk about actually getting a deal done. Maybe I'll ask you two gentlemen, because tech and biotech are, so maybe Mark, you first. So lots of sellers and buyers fail to come to agreement. For whatever reason. It could be including valuations are at an all-time high or an all-time low. The potential seller says, I see a lot of upside in my business. Why am I going to give most of that away to you? Any recommendations for kind of creative structures to kind of facilitate deal flow?
Yeah, valuation is always kind of that topic, right? And especially in tech, where you think about the last few years, let's say 2020, 2022, 19, right? Tech was at an all-time high, and the valuation that folks had in mind was significantly higher than, as we sit here today, it's probably half that. And so trying to get to that, trying to get to the right place is difficult. And again, it's a matter of negotiation and working through it. We did a transaction 4 years ago now, where it was a stock for stock deal in a private company. So it was what was that valuation, everything, and we got to the point where we had a deal, and then the seller came back and said, okay, but what if when you sell the combined company, what if valuation is an X? So, we had to, it's like, okay, so we worked through a transaction where we said, okay, all right, let's define what that minimum is, right? And then we put warrants, right? We added warrants to the deal in order to get them to the point, right? So we were comfortable that we wouldn't sell below this. So those warrants were, let's just say, was nothing out of our pocket. And they were comfortable that, okay, with those additional warrants, we could move forward. And so we did, we scheduled, or we did the transaction in that manner. There's always, everyone's, I've had this conversation with our own management about, things are gonna be so much better. We spun off a company 2 years ago, a business unit, and the leader of that business unit didn't wanna do the transaction, right? It wasn't enough money, right? Everything was gonna be so much better. Every investment banker I talked to thought it was the best deal going at the time, right? And so there's this disconnect. And again, so what we did is we had an earnout, right? Just, again, if we think we can perform, right, then okay, we'll take X today and we'll take Y tomorrow if we do perform. And we try to structure it in that manner. So we've done different things like that to get a deal done.
Great stuff. Lou, anything you'd add?
Yeah, I mean, there's not a lot that I would add as well. I think the biggest thing is you really need to have a champion on both sides, right? I mean, I think that's important, and you need to have creativity, because everybody, even in our own personal lives, when we go to sell our used car, we all think it's worth more and the buyer thinks it's worth less. So we always have to get into that. But if you have a champion that really wants that, 69 Mustang, then they're going to pay whatever you can for it. But at the end of the day, you need a champion, you need creativity, and you need to have some creative minds going on. I can think of an example that we had done years ago. We were looking at a deal. We were trying to acquire an MS drug from a private company, but they also had a second asset they were trying to partner with Novartis. And they wanted to package the whole company together, right? And we didn't want the second asset. So we actually walked away from the deal, and then a few months later, we came up with a very creative way, because Novartis wanted the other company to actually do the trial, and then if it turned out to be a positive trial, they were going to actually acquire the company. If it wasn't, they were getting nothing except for Novartis was going to pay for the trial. So we came up with a creative way, and that's where I'm going with this. I think champion in creativity. How we made it a creative deal was we actually went to Novartis and said, listen, we'll do the trial, and we'll actually take the lead asset that we want. You give us equity and you pay for the trial. If at the end of the day the trial works, you can pay the company, because we don't want it anyways, anything you were going to pay them originally for that other asset. If it doesn't, then the other company didn't make anything. So we actually were able to creatively put that deal together, because we had the champion both of Novartis and we had the champion of the other company. They ended up getting their lead asset sold to us. They ended up, without putting any more money into it, their second asset that we did for them, Novartis paid for. And at the end of the day, unfortunately, the trial didn't work, so they didn't get the second part of the equation. But champion and creativity is all I would say.
Let's talk about integration. Good advice there. I think if maybe, we talk about programmatic M&A. You're doing multiple deals a year. Maybe you're doing a couple deals at the same time. If you're doing small, mid-sized deals where there's quite a bit of uncertainty, like in your sectors. That kind of creativity that you can create this win-win. Sure, you're not maybe keeping as much value as you want, but that actually is kind of the key to really unlock this kind of buyer-seller disconnect. Let's talk about integration. Shu, I'm going to go to you. You said the start of a marathon, start of a marriage, I've heard.
Yes.
Two-parter, advice for someone who's never fully experienced an integration, and then what do you see great CFOs doing on an integration?
I think the two things. Number one is go back to I probably mentioned many, many times today, which is what is the deal thesis and what is the value you see from these assets and how the integration plan that ties to the strategy that we have for this deal. So I think this is very important. There are so many things going on with integration, and a lot of companies hire a consultant like a PMO office to manage the integration process, and many cross-functional team works. But at the end of the day, when we look at the whole plan, am I going to achieve my deal thesis? Am I going to the direction that the strategy I set up? So I think that's number one. Number two, I found, again, there are so many cross-functional partnerships through the integration. I want to make sure that we have one owner for each work stream, one owner. Mm-hmm. The person could probably work with 100 people to do the one work stream, but I need to find an owner for that. So, and then I can hold the person accountable for that success, failure, delay. Because otherwise, I have been into a situation in the past that when we say, okay, this work stream has 20 people on it, and if it is delay, we couldn't find who is actually responsible for the delay. So this is one lesson I learned. I learned in a hard way that we need to find one owner. It can be many people on the work stream, but one owner responsible for the beginning to the end. So that's two advice I want to share with the team.
Yeah, that one is very, very important. At Form Labs, we call it the formling in charge, and it doesn't matter how many people are connected. It doesn't matter whether they're a solid line, dotted line. They work at a different company. Like, you are responsible for the success or failure of that work stream, no matter what. I'd say one thing to always consider or aim for is keeping things really simple. Everybody is smart. You have lawyers that charge by the hour. You have accountants that charge by the hour. You have bankers that are trying to get this thing done and out of there. You need to keep it simple, and you need to have a plan before you go in. The number of times I've seen companies, and quite frankly, in my space today, and I'm very happy for it, is they've seen an asset that they like. They go and pay a price that I wouldn't pay for it, but maybe it made sense at the time. And then they realize they have 11 different assets with 11 different G&A functions, with 11 different ERPs, with 11 different engineering groups. And they say, oh shit, this is expensive. You say, oh, like, no. Of course it is. And so then they say, okay, we're going to go through an integration plan. And we're going to go through an integration strategy. We're going to save $100 million over 3 years. And there's zero chance that ever works, because there's about a 50% chance that it works when you do a huge amount of diligence up front. You align the cultures. You know which system you're on. You know who's going to lead each group. You know where you're going to put all your 37 offices that you have. And so, number one, which I was impressed at, the lack of diligence being done, and maybe that's sort of 2021, for you, is you need to have these things laid out before you do it. You need to have one human who's in charge of the success or failure of each of those. You need to be very clear, at least at the highest level, of who's going to own it on the other side. And you want to keep all of that as simple as possible, because I'll walk into a room and you've got people from both sides have like a 37-page document as to how you're going to transition your CRM versus, and then you have a different team that's going to transition your ERP, CRM, and you're like, no, this is all the same. This is all the same. We need to get on our own systems. We need to get on one set of systems, right? And you can find that in HR, R&D, IT, every single group, and you need to keep it simple at each work stream. Otherwise, you're going to have an absolute mess. And even when you do a great job up front, there are a lot of things that you miss. And so even then, the success, I'm sure, if you have McKinsey, the success will be much higher. But for the rest of us, success, even when very well diligenced, is lower than you'd prefer.
Yeah, that's great advice. I think the only thing I was, and this is not to be curse or anything, but I would make sure that us as CFOs or anybody on our team is, especially when you have these leaders of the integration, I would encourage your entire teams to leave their egos at the door. Because what ends up happening in all these cases, finance always thinks they're, the most important person in a transaction, and they are in certain things, but it's more dealing with the bankers and the valuations and things like that. When it comes to integration, I mean, having somebody, a non-finance person leading an integration team is probably, good program managers is really important. And, just again, I would advise, I've seen too many deals go south, or not south, but just a lot of drama happen for nothing because somebody clearly wants to be head of integration and it really shouldn't be them or not, or someone on our team. So I would make sure that as finance people, we just let people know that our role is valuation, things like that. And it's always the diligence, obviously, but if we're not head of integration, it doesn't mean we're not the most important person. So I would advise to leave egos at the door when it comes to integration.
I think the other thing which is important is, you got the buyer and the seller, and a lot of times the buyer knows best. And I think that is, as a buyer, you've got to be, you've got to be open-minded and really understand what you're acquiring and what they're doing before you do that integration. I was with a company, I walked in 3 years after the deal was done, and it was still we and them, we versus them, right? And it was mind-boggling to see 3 years later. And as I learned more, there were so many mistakes because there was a go-to-market strategy that the buyer had, and they just thought that they could take what they bought and put it through that go-to-market strategy, and it failed. And it failed twice, and then, I came in as part of a sales ops team and a leadership team to change everything, to kind of bring it to the market the way I guess it should have been brought to market, which was the way the seller was doing it 3 years earlier. And so taking that time and, making sure that, yes, you may know a little bit, you might be a little smarter, but take the time to understand and do the right thing from an integration perspective.
We didn't script this. I didn't know what their answer was going to be. The three things I wrote down are the three things you said. So I'll just recap, and then maybe we'll open it up to the audience, if that works. The value drivers, Shu's point, she keeps saying value drivers. What, what are the words?
Deal thesis.
Yeah, the deal thesis. What is this? Why are we doing this deal? A CFO who says, bless you, a CFO who says, if we look in 3 years, this deal was successful because, or unsuccessful because, and making the organization spend 80%, 90% of their time on those things. This deal was successful because these two growth drivers that we think should happen, happened. We reset our cost base, our corporate cost base, and now have top quartile margins. And the people that we think are critical to make those things happen, they're here, they're happy, they're engaged. Is your integration plan focused on those three things? It'll be successful. So that's maybe the first thing you're saying. I think, look, the second thing, if it's the most important thing, if this acquisition is the most important or among the most important things you're doing, staff it as such. Staff it as such. We don't know what to do with this person, this guy or girl. Let's have them work on the integration. No. This person is a future leader of our company. This person is a future leader of the company. They need to work with this business leader who needs to devote 50% of their time to making this integration work. So staff it as such. Don't sort of stop at the start. The third point, which I love, unless it's a turnaround or a distress asset, you are probably buying this company because they did something that you could not, or they did it faster. They developed this amazing drug, this technology. Having that sort of humility and that learner's mindset, how did you do it? Who did it? And we talk about going slow to go fast. There will be time, get the day one plans. What's day one critical? Legal, finance, HR, et cetera. Take the time. How did you do it? Who's critical? That kind of learner's mindset, that humility, instead of we know the right way, look at all this value, we're the big company, we're the acquirer, that is a mistake. That is a mistake. Go in with humility and a learner's mindset. Okay, hopefully that was a good summary. Maybe questions on your mind. Mary here has.
Yeah, I have a mic.
Yes.
I don't know if I need the mic. My question is mostly for Dan and Shu, but I'm willing to hear everyone to understand it a little better. So I kind of noticed over the last few years there's been a shift away from looking at the financials specifically to make a deal. I think when I first started my career, it was like, oh, the P&L looks good.
Yeah.
I'm good to go.
Yeah, procurement.
Now,
It'd be like a procurement exercise.
yeah, I'm curious, how has that weight shifted to looking at the non-financial items like systems and tech stacks that's attached to a company, and the cultural aspect as well, looking at the people in the org chart? But also, when are you doing that cultural aspect? Because I was part of a purchase in the PE ecosystem where we had legacy employees that were still on the platform but no longer fit the new structure and strategy. And it's kind of stronghold the process and the growth. So I'm curious, when is that happening these days based on your experience?
You want to start? You want me to start? Yeah, so I think you're always at some point buying a P&L and a balance sheet, right? But when you're looking at things, you're never buying a company because they have a great tech stack or an easy one to to move off of. I think the culture, maybe the core of your question is like, how do you identify the core culture, and whether or not you're going to have a combined entity that's rowing in the same direction. And I think the short answer is you have to go one level down into the organization, and you have to get comfortable letting your one level down, right? As myself, another CFO, the CEOs can sit in a room and everybody can like shake hands and decide this is a great thing. Everybody's going to have 3 boats now, and we're going to have a business that's 3 times the size, not 2. When you're getting into that next level down, that's where you start seeing the cultural breaks or the cultural alignment, and actually like letting people get closer than you might otherwise be comfortable with, or maybe the bankers say, like this needs to be super tight, and it certainly does, especially in a public company setting. But letting people who are actually going to do all the work get down and understand, like, is the comp structure at this company completely different than the comp structure at that company? I did a deal that was in the consulting space, and in one company the management got paid very well. In the other company, the people who went out and billed hours got paid very well. And so you put those 2 cultures together, and all of a sudden, either everybody's getting paid really well and that math doesn't work, or nobody's getting paid the same as they were. And you need to work through that beforehand. I think oftentimes the inclination is to say, yeah, we recognize that's an issue. We'll deal with it after the deal's closed. It's like obviously the worst time to deal with it, because it can create a pretty serious issue. You might have had like a second half of your question here.
The weighted component, understanding if financials were weighted, let's call it 85%
Yeah.
before, now is it more 50%? And I want to clarify something. On the tech stack piece, what I meant was when it comes to integrating into a portfolio of companies,
Yep.
they're now overemphasizing having a proper tech system so it smooths that integration out, because that can elongate your sell time another year or 2.
Yeah, that can. I've never had that be like the issue ever. You can cut off the old, bring on the new. It's going to be more expensive. I usually add a 20%, 30% buffer to whatever I think it's going to cost to do an integration, because whether you account for it in the upfront when you're paying consultants and additional people to do it, or whether you're paying for it over the life of your relationship with the acquired or acquiring company, like you're going to pay more than you thought. So I don't know. Shu, do you have anything else to add there?
Yeah, I can add a little bit. I think what Dan mentioned, is really helpful. If I think about your 2 questions, your first question is why the world changed from looking at P&L only, now looking at everything else. I can comment on that one by, I came from a PE-owned environment, so when PE buy any company, they're looking at exit value. So it's not only today, it's more about in 3 years, how I'm going to turn this assets to be 3x, 4x. So that's why we're not looking at your current quality of your financials, but looking like, okay, the next 3 to 4 years, how am I going to execute this 3x, 4x value? So because of that, we are not only, the finance team can only do so much. We need to have other team, right? The R&D pipeline, the technology, the automation, the revenue expansion. So that's kind of a reason why we actually spend way more time on other stuff, due diligence, than just the financials. Again, this is just from a PE-owned environment, because we're looking at the next 3 to 5 years. And then your next question is how the culture piece. This is a very interesting point. I found it's very depending on what company that you are acquiring. So if you are acquiring a company that is professional run, venture backed, and in their board, they have a lot of, investors, right? So everybody has a little say on the table. So in this environment, it's more professional, right? You look at, what a value, what is the deal thesis, how we structure it, so everybody gets some returns for your existing investors. So this is kind of a simple, straightforward way. Another way, sometimes it's get a little more complicated, is when it's a founder-based, founder-led, and the founder is going to stay on. So then this founder is becoming very, very important from the very beginning to the end. Like why, we need to, and some founders is different. Some founders have a lot of say on the table, and they put a lot of efforts. Buildings come from 0 to 1, right? They really want to find a partner. So you may want to find out why he want to sell the company at this time of his life, and how he can, partner with you, or he just want to get some return out of the cash. Right? It's all kinds of reasons we need to find out during this due diligence process. And number 2, what kind of a culture, he tried to build, and what kind of culture that we already have, and how we're going to integrate together. Are we fully aligned? And we need to have two cases. If we're not aligned, what is the worst scenario? If it is we're aligned, what is the best scenario? So we always need to prepare the 2 scenarios for the founder lives, companies. So I would say, the culture piece is we need to assess from the beginning to the end, and depending on the situation of your company that you're acquiring to. I hope that helps.
Maybe your question's great, because if you ask integration leaders, what are the things you spent more time on, wish you had done differently or spent more time? Number 1, by a lot, about 50% of people say culture. About 30% of people say systems. So right there, you got kind of 80% of why deals don't maybe achieve full potential. So your questions, I think, are related to that. My 2 pieces of advice maybe that you could take tomorrow. One would be, what is your own culture? What is your own culture? Do you actually have kind of a systematized, documented way of this is how our work gets done? We actually are more data-driven. We're externally oriented. Our roles are clear, or not. Having a good sense, an unhealthy culture, trying to fix that in an integration is a bad idea. A healthy culture with a good understanding of what you're strong at, maybe how work gets done, will be helpful. On systems, similarly, maybe it's not an integrated tech stack, but at least a clear roadmap that if you're buying or selling, you could say sort of here's how a system. Now, does systems matter? If you're a CFO, it might not. But if there's a lot of synergies tied to systems in this deal, that better be something that you involve people in diligence around. If there's not, then maybe it's less important. But so those would be two ideas. What is your current systems roadmap and plan? What is your current culture? That'll help you as a buyer or a seller. What else?
Can you pass the mic down?
So I have an observation, and it's based on my experience. I've been on 2 sell-side transactions the last 3 years and gone through 2 due diligence processes. And I think what I saw in both cases, there were strategic buyers. The due diligence team was not really aligned with the buyer's priorities, so we spent a whole lot of time fielding due diligence that I questioned. Much of it was irrelevant, and much of it that should have been included was not. And the result was, after the transaction, the new owners started asking a lot of questions that should have been already dealt with, and it's certainly delayed, an effective, smooth integration. And I don't know what to do about it, but it certainly is a learning that, when I'm on the buy side in the future at some point, that's one of the things I have to make sure it gets handled properly, because I think a lot of it was wasted effort.
Quick question beyond the sell side and the buy side. For the organization that would be integrated, any recommendations on that end?
If you're getting integrated.
Correct.
Yeah. Don't all jump on it.
Yeah.
Oh, great question.
It's
Yeah,
a
no,
good question.
It is. So as the company being integrated, going into it with a really open mind, and I'll give an example here. It was one of the first sell-side deals that I had worked on for more than a couple of months. It took about a year. The company that was getting integrated in, I worked closely with their CFO, and he was trying to get me to come out and move and work for him. And I was like 24, 25 at the time. And I said, A, I'm not moving to LA. And B, I haven't done this for very long, but you're going to get fired. And again, I didn't know that to be the case. I said the way they'll do it is they'll promote you from CFO to VP of Finance, and I'm not going to come work. He said, like, you have no idea what you're talking about. You are 24. You've never seen this before. 2 weeks later, he called me. You have no idea what happened. Exactly what you said. I followed your advice. They paid me a couple $1,000,000 to leave, and so the next place I'm definitely taking you, which ended up doing. But like going in with an open, mind of what is going to happen, and you can never never trust people 100% to tell you what's going to happen. But going in with an open mind of if I'm the buyer, if I'm on the other side, what needs to happen to make my model work, and then what is the operational impact of that, and then signing up as to execute against it, not pushing. You don't understand how we do it. It is very important. If you guys are doing it better, that's meaningful. But really buying in and like going in with an open mind rather than, okay, this is like a new project that I'm doing. If you're not used to that, you have to like step back and say, what are they trying to get out of it? What are our sellers trying to get out of it, or what are we trying to get out of it? And really look at it with an open mind. Maybe not quite as cynical as I am, but understand if you were on the other side, how would you be doing that? And then if you're aligned to that, you execute against it. If not, right, maybe you decide that it's not the right place.
The only thing I'd add is, spot on there, again, transparency and open mind. We had put two companies together years back, a company called Idera and BioChrist. And in that case, we actually had spent more money and time on the cultural integration of those two companies because we were looking at a Cambridge facility, an Exton, Pennsylvania facility, one down in Research Triangle and one in Birmingham, Alabama. And we basically had to try to figure out to make sure who was staying, who wasn't staying, where your job was, if you wanted to move, if you didn't want to move. And we were honest, even before the transaction happened. We weren't even sure if the transaction was going to happen. But what we did was we put a boatload of money. I mean, we're talking millions of dollars into an integration plan. And ultimately, if the transaction were to happen, everybody knew where and how long they had and how long this was. It was a 5-year transition period. And everybody was treated with respect and everything. And you had an opportunity to be part of NewCo. But I would echo what Dan said, but also transparency and just making sure that everybody understands if they're not going to be part of NewCo, that they know now and there's a respectful transition for them. And they know that instead of finding out 2 weeks after the transaction happens.
Yeah, maybe it's ask the question, right? There's like an expectation that everybody knows everything that's going on, and the communication's been stunning throughout. And again, oftentimes it's not malicious. It's just we have a lot of things that we're dealing with, and so if you're on the the acquired side, ask the question.
And these were two publicly traded companies, so we actually had to work closely with the bankers, with the lawyers, of how much we couldn't say. So it was very complex, but both CEOs and both boards wanted to make sure that, to your point, there were no surprises after. And us, for a successful NewCo, we needed to put all that up front. So it was challenging, but it was successful.
Even as the acquired company, the integrated company, I think you play a role in focusing the organization on what matters. What's the deal thesis? What is going to actually make or break this deal? Everybody playing that role, being like, guys, is this the right thing? Is this going to make or break this deal? I think that would be sort of piece of advice number one. I love this idea of like treat each other like adults. Be transparent about what's going to happen. Don't have us spend 6 months trying to figure out what's the right ERP platform if you know it's yours, or don't, like, let's be honest, we're all adults. We knew what this entailed. I think the other thing you have an obligation, I think, to showing what you all think you're good at. What are we good at? What do we think you should maintain or enhance or be mindful of if you get rid of in this integration? I think that's your obligation from my point of view. What are you good at? And what do you think, if it really is partially best of both on the integration, what do you think you're best at? Maybe time for just a quick one, or?
Yeah.
Yeah.
Can I just add one thing, being
Yes.
on both sides? I would just say, as CFO, if you're being acquired and you have a transition with them or whatever, everyone in the company is looking at you.
Yeah.
Like, how are you
model.
acting? What are
Yeah.
you saying?
Great
And
advice.
I think it helps if you assume goodness on the other side. They didn't do the transaction to kill the business, right? They did the transaction to grow the business.
Great advice. Yeah,
yeah.
how you role model, how you show up,
Yeah.
how you talk about it is important. That's great advice.
Thank you. Just a quick question regarding maybe the last step on the deal regarding the SPA. Based on my experience, sometimes we make all the steps, due diligence, and all is aligned, but in a legal view, maybe are not on board from the beginning, and we have some or misunderstanding or something that are not running like we think, no? So based on your experience, what is the main topics or main things to consider in this part, in the SPA, in this agreement, in order to close the deal between the buyer and sellers?
Anybody?
So-
Go ahead.
Yeah, I'm hearing maybe you've had an experience where there's some technicals within the SPA that maybe your lawyers are pushing you on. You're not sure whether or not it reflects the economic or commercial agreement that you believe that you're entering into. Is that? Yeah. Okay. So lawyers are unbelievably good at making things more complicated than they need to be, right? When you're spending over $1,000 an hour, they're going to tell you all the things that you forgot about and all the things that need to get spelled out. And what I find is keeping the commercial agreement, right, very, very simple, and pushing your lawyers to only give you what absolutely needs to happen to prevent something from blowing up and to have a huge amount of liability at some point in the future. Like, we're almost at time. Yeah. Like that's my advice. You can get wrapped up when you have a lot of very smart people trying to make something more complicated than it needs to be. Most often it's when you have a disagreement or a disconnect between the commercial agreement between you and the other side that you end up going back to that document. If everything goes well, that thing sits in a drawer, right? It's when one of you gets hit by a bus or you have a disagreement on what the actual commercial terms were, that's when you say, oh shit, did I have this spelled out? And like, you don't need to spell every single thing out that your lawyers tell you.
I think we in antitrust, we actually talk about it similarly. A lawyer, if presented with a yes/no question, will say no. So, and I mean that they're doing their job. Their job is to protect a company. Instead of in antitrust, and so for example, if you're in a regulatory period, what I would like to do is the following. How would one do something like this? They might say, put this in a clean team, or you could do it at this level, or only these 5 people can do it. So instead of presenting them with a yes/no, engage them in the problem solving. That and sort of help direct them. That's sort of similar advice. Engage them where to focus. Hey, we're wrapping up. I want one piece of advice from each of you. I'm going to start on the end, and we'll go this way. One piece of advice.
Okay. Consistent with maybe some of the things I've said earlier, would you buy the company for $1 is a great starting point. Because you can end up doing a lot of work, and then you sit down and you say, should I buy this company for $1? And if you can't answer that with confidence, you should not spend any time on the transaction.
Okay, love it.
My piece of advice is communication. So I found no matter how much you communicate, it's always not enough because there's so many things going on. So I highly recommend that we put together a communication plan and get aligned with all the parties. Like who should be notified, who should know, when and how, and who, what. So this way, everybody is aligned and through the whole process, because the different phase, you communicate different level of information to different level of the, within the organization. So let's get that one aligned first. So it will make the whole process much smoother, and you're gonna get a lot of compliments saying that the communication, the work stream is much clearer. So that's one of my piece advice.
And I'd say, keep an open mind and be flexible, right? As you go through this process, there's lots of things that are gonna be different than what you would have thought. And, you can get emotional about it, or you can kind of just, keep that open mind, stay flexible, and find the solution, I think, versus just, saying no. And I think that's important as you go through any transaction, because you'll hit many roadblocks like that you gotta work through, and you gotta do it with an open mind to get to the end result.
Yep. And similar to what everybody said on this panel, again, I think it's more importantly, if it were, I know what I'm about to say is a fact, if it were your true money and you were buying it, would you be willing to do that deal? And if so, then, you have an obligation to do it either way, as long as you have fun. Just have fun while you're doing it, because 6 months after the deal's done, it's on to something else. So don't get hung up in the moment. Just really have a lot of fun while you're doing it, because you can learn from a lot.
Thank you all. Thank you for the great questions. My piece of advice, if we are entering a boom, semi-boom, write down your strategy. Write down where you need M&A. And if the transaction volume starts to increase, PE's been record hold times, cash on the sidelines, record levels. Could be a lot of deal flow. Look back and say, does this deal sort of help us accelerate what we're trying to do in M&A? Or is it just a procurement exercise and it looks good in our spreadsheet? That's my biggest piece of advice if we're going to enter a boom. Thank you for your
All right, thank you.